Building a strong credit score opens the doors to so much more than you think. Whether you're aiming for that dream apartment, the best rates on a car loan, or travel cards that can give you incredible experiences like these at a fraction of the cost. But maintaining and improving a high score takes know-how, and even the smallest of mistakes can cause big dips. Like recently when my own score dropped by over 30 points from some completely avoidable mistakes, teaching me some valuable lessons along the way. So in this video, I'm going to walk you through everything you need to know to build, protect, and improve a great credit score, avoid common pitfalls, and maximize your opportunities. So when we talk about credit scores, think about it as like your financial report card. But instead of math or science, it's grading you on your reliability of handling money and debt. This score ranging from about 300 up to 850, with most people hovering around 5 to 700s, give lenders a quick way to gauge how much they can trust you with borrowed money. Lower scores generally means you're seen as a risk, whereas higher scores signals that you're reliable with credit. Essentially, it's like your reputation score. The more you consistently pay off what you owe, you'll build a higher and higher score as someone who has a reputation of being trusted. But if you constantly miss your payments or you're maxing out all of your credit, it sends a message that you may not manage debt well and then have a lower score. But why should you care about this number? Well, with a higher score, you're actually in control of a lot more. For instance, it can open up doors towards the dream apartments you actually want, like in New York City, where some rentals ask for at least a 700 score. Or it's your ticket to premium cards like the Sapphire Preferred, loaded with hundreds of dollars of credits, or the American Express Platinum card with over $1,000 of perks. And it's the best way to get the lowest interest rates on loans. It may seem like a small difference, but even a half or 1% point can mean the difference of $50,000 or $100,000 over a term of the loan. And it's not just the big life-changing things too. A strong credit score helps you with everyday savings as well, like qualifying for that Black Friday phone deal or lowering your insurance premiums every single month. Whether you're trying to save money or just make life easier, a strong credit score goes a long way. And here's the thing, this 3-digit number boils down to just 5 factors, each of which will break down exactly what they are and how you can tackle them so you can take control of your credit future. Alright, let's start with the single most important factor of your credit score, your payment history. This factor alone makes up 35% of your credit score. So if you get this part right, you're already well on a path to a great score. Think of your payment history as your track record of being reliable with debt. It reflects how consistently you've been meeting your obligations to pay back borrowed money, like with credit card payments, car loans, or other lines of credit. I mean, imagine a friend who borrows money all the time but is always late paying back. Or worse, sometimes doesn't repay at all. You'd probably hesitate to lend them money again in the future. Lenders work the same way. They look at your payment history to see how much they can trust you to pay back future debt on time. Now, although I have a 100% payment history according to sources like Credit Karma, that doesn't mean I've never made a mistake. In fact, about a year ago, I missed a payment after opening a new card and forgetting that first bill. Fortunately, with most issuers, so companies like Chase or American Express, won't immediately report that to the credit bureaus who handle your credit score. More likely than not, you'll probably be charged a late fee if it's just late within that 30-day window. And if it's your first time being late, then they may even consider waiving that fee. If that late payment continues after the 30 days though, and they do report it to the credit bureaus, you not only rack up interest charges on that unpaid balance, which at 20 to 30% interest rates is not fun to pay, it could also stay on your credit report for up to 7 years. So to dodge all of those issues entirely, follow what I like to call the golden rule of credit cards, which is to pay your bill in full and on time every single time. That means when you spend in 1 month, receive your bill in the next month, you're paying the entire amount before the due date, which is typically the month after. There may be some reasons reasons why you want to pay it off even sooner, but we'll get to that later in this video. But the way I make sure to have on-time payments without fail is to set up auto pay across all of my cards, which I obviously forgot to do with that one new card last year, but it's something I've relied on over the last 7 years. This way, the issuer will automatically pull the full amount before the due date. That said, it's not just set it and forget it. It's more like a protection to make sure you're never late on your payment. I'd still recommend checking your bill every now and then to make sure there's no unexpected or fraudulent charges. If you do, call the issuer right away because they should be able to take it off of your bill while they investigate, which has happened to me a couple times before, and it's only like a 5 to 10 minute phone call. With these strategies, building and maintaining a perfect payment history is very achievable. Alright, next we're diving into amounts owed, otherwise known as credit utilization. This factor makes up a hefty 30% of your score, so getting this right along with payment history means you're golden in terms of your credit score. Now let's break down amounts owed into two parts. The first one being the total amount of credit you have. Say you have 5 credit cards, 3 at $10,000 of credit limit, 1 at $8,000, and another with $2,000. Adding these up, you have a total credit limit of $40,000. That's your first number. Next, look at your monthly spend across all of your cards. For instance, if in that month you're spending $2,000, then that's your second number. Now, by dividing the $2,000 by your total credit of $40,000, you get a 5% credit utilization, which is pretty fantastic. Guidelines usually say to stay under 30%, but if you really want to maximize your score, you'll want to be under 10%. For me personally, across 6 different cards, I have a total credit limit of $123,000, usually with a 1 to 3% credit utilization. This approach has been key to maintaining a solid credit score over the years until something recently changed. You see, most people here really just think about total credit utilization, but it's actually both the total utilization and the per card utilization that factors into the score. Each card's percentage plays a role, even if it's less significant than the total utilization. A few months ago, I signed up for the Capital One Venture card to take advantage of the elevated welcome bonus of 75,000 miles and $250 worth of travel credit towards their portal after I spent $4,000 in the first 3 months. But surprisingly, when I got approved, it was for a lower than expected credit limit of just $2,000. Now that's already challenging because that meant the limit was under what I needed to spend to meet that minimum spend. So as I began using this card, my credit utilization of the card started to spike. I even got declined a couple times because I didn't realize how fast I was approaching the $2,000 cap, which also meant reaching that 100% utilization rate. And even though my total credit utilization stayed low, which is still the one that matters most, that high credit utilization ratio on my venture card contributed heavily to that 35-point drop. So here's the tip. If you're planning to spend a lot on the card, pay it off as soon as you can. Had I been more aware, I would have more frequently paid the card off throughout the month to keep that utilization low and avoid that spike in usage. But lowering your spend is just one side of the equation. The other side is trying to increase your credit limit if possible. Thankfully, Capital One allows you to request for a credit limit increase with only a soft pull, meaning they'll check your credit report without an impact to your score. It's something I did a while back when raising my credit limit on my Capital One Venture X card from $33,000 to $40,000. But maybe we can do the same right here with my Capital One Venture card. So not only will it give me more wiggle room to spend on the card without hitting that cap and being declined, I'll have a lower credit utilization on both the card itself and overall. Now, before we jump in, here's another quick tip, which is to always keep your income up to date with the issuer. This is one of the factors they consider when deciding how much they're comfortable lending out to you. Here with Capital One, you can access the box to update your income through the I want to menu and entering it there. Once that's updated, go back and go to the bottom left corner where you can request for a credit limit increase, which will give you that pop-up form. Here, it first asks you what's your annual income, which should pre-fill from your previous screens. Employment status comes next. I'm employed, but there's other options depending on what's your status. Then it'll ask for your occupation. For me, I'm a software engineer. Next, your monthly mortgage or rent to see how much of your income you're already spending paying for your living expense, given it's typically one of the largest expenses from anyone's budget. Then how much you plan to spend with a card, so they kind of know how much they even need to extend to you. And then and how much of a total credit line you want. Given I'm only at about $2,000 right now, I'm gonna try and ask for $10,000. Finally, it'll ask you what's your reason for this request, with some drop-down items like having a one-time big purchase or just higher spend over the next few months, in addition to a few other options. So for me, I'm gonna select having a higher spend over the next few months. And then now I'll go back, fill in the things and press submit, and great. They're giving me a bump of $4,000 to my credit limit, going from $2,000 up to $6,000, which I'll gladly accept. Simple as that. And having walked through that, it's worth noting that I've only had this card for about 2 months and was still able to get an increase. So if you're also thinking about doing this with your Capital One credit card, then treat that as a data point. So now instead of spending $2,000 and hitting a 100% utilization ratio, I can charge the same amount and only hit a 33% ratio. It's still a bit high and I'll still want to pay it off more regularly, but it's much better than before. With this improvement bringing down my credit use ratio on this card, along with continuing to practice good credit habits, I should see my score gradually improve over the next few months. Alright, let's dive into your length of credit history next, which accounts for a 15% portion of your credit score. While it might seem like a small piece compared to your amounts owed or your payment history, it's actually one of the easier factors to get right. So what exactly is length of credit history? Well, it's basically a measurement of how long you've had your credit open, with a few key details to keep in mind. The age of your oldest account, the age of your newest account, and the average age across all of your accounts. Together, this tells lenders how long you've been managing credit and gives them a sense of your reliability and consistency. For example, I got my first US credit card back in 2015 during a summer internship, and then opened my first actual US credit card in 2017 when I moved down here full time, with my most recent personal credit card opened just 2 months ago. Now, the exact weights of how all these factors are measured isn't too clear, but right now Credit Karma is estimating my average age to be around 3 to 4 years, which is one of the weak points of my credit score. Also, this is why starting off your credit card journey with the right beginner no annual fee cards is so important. Because with cards like the Chase Freedom Flex or the Citi Double Cash card, you can keep them open forever without paying any cost, which lets you continue to increase your credit age for free. But there is one thing to keep in mind, which was a lesson that I learned the hard way. If you aren't using one of your older credit cards, make sure to at least keep it active. You can set a small charge on it, like a recurring subscription, to make sure it stays open. My first US card back in 2015 was actually closed because I kind of forgot about it and it went inactive for too long. So while it'll still count towards my credit score for a while longer, I'll lose that history when it finally drops off at around that 10-year mark. And instead, if you do have annual fee credit cards that you don't plan to use anymore, considering downgrading them to a no annual fee version instead of closing them out. For example, you can downgrade the $95 annual fee Chase Sapphire Preferred card to the no annual fee Chase Freedom Flex or Unlimited cards, letting you keep that account open even with the same number without a fee while keeping that history. So to recap, start early with no annual fee credit cards you can keep open forever for free, set up small charges if you need to in case they go inactive, and downgrade rather than close accounts whenever possible. Length of credit history doesn't require that much maintenance. Once it's set up, it's mostly letting time do its thing while you keep good credit habits. Now onto credit mix, a smaller piece of the puzzle at 10% of your score. But just like credit history, it's not a factor that takes much active effort, but is good to know what it's all about. Think of credit mix as the variety of different accounts that you have. Credit cards, auto loans, home loans, or even student loans. Lenders see a well-rounded mix as a positive signal that you can handle different types of credit responsibly. But if you only have credit cards, don't worry. While having a car or a home loan might help your score just a little bit, it's definitely not worth getting into debt just for this purpose. In fact, for the first 6 years of being here in the US, my credit mix was just credit cards, with no issue having an excellent credit score up into the high 700s. And even though I've added an auto loan within the last year, it doesn't seem like it's actually affected that much, if at all. The takeaway here is to not stress over the credit mix. If other types of credit naturally comes into your life, like a home loan or an auto loan, great. That'll add some depth into your profile. But for most people who are just starting out, your credit score will grow just fine with just credit cards. Okay, diving into new credit, another factor that takes up 10% of your score, which centers around three main things: how many new accounts you've had, how many recent inquiries you've had, and how much time has passed since your recent account opening, which in my case is 2 months. But why do these factors matter? Well, if you're opening a ton of new accounts in a short amount of time, that's a red flag where you might be desperate for more credit to use, not good. And when it comes to recent credit inquiries, that's where these hard pulls come into play. When the lender checks your credit profile for a new account, it'll result in a hard inquiry that can cause a short-term dip of 5 to 10 points, though it'll stay visible on your credit report for up to 2 years. Come to think about it now, this factor probably also played a role in my 35-point dip recently, given the hard pull and a few new accounts I've opened over the last year or two. But here's the thing, while there's a common myth that opening new credit cards is a bad thing, yes, you might have that short-term dip, but all of the longer-term benefits far outweighs that dip. Why? Because with each new account, you're building a higher overall credit limit, which lowers your credit utilization, another account that adds to your credit history length over time, and another account for more track record where you're paying off your bills in full and on time every month. Luckily, I'm not aiming for a big loan anytime soon, but if you are, like say you want to get a mortgage, consider pacing out your new applications. That way you're avoiding any temporary dip right at a time where you're applying for the lowest interest rates on a big loan, which if you have all the right habits in place and you understand how all the different factors into your score, then you're well on your way to building a strong credit profile that opens a ton of doors. But remember, it matters how and where you start. Setting yourself up with the right beginner credit cards makes all of the difference. So check out this video for my top picks on building credit the smart way, and I'll see you over there.